Hello, everybody, and welcome to another episode of Accounting During the Day. So we're going to look today at problem 18-3. So first one over here is Grill Master offers contract GM 205, which is comprised of a freestanding gas grill for a small patio use plus installation of a customer's gas line for a total price of $800. On a standalone basis, the grill sells for $700, costs $725, and Grill Master estimates that the standalone selling price of the installation service based on a cost plus estimation is $150. The selling price of the grill and the installation services are two separate performance obligations. Grill Master signed 10 contracts on April 20th, and the customers pay the contract price in cash. The grills were delivered and installed on May 15th. Prepare journal entries for Grill Masters for April and May. Okay, so we have something here that's similar to one of our other former questions, which is that customers are paying $800, but over here the grill and then the installation. The grill has a retail of $700. Installation has a value of $150. Okay, so over here, the total value of what's being given is $850, but the customers are only paying $800. What I then have to do is to allocate those service prices, that basically the price. So my allocation, which is going to be a percentage of the total, 82%, 17% for a total of 100%. What I then do is I basically take my sales price, call this percentage of total. My sales price is 800, and then this will give me my allocation over here to get my total of 800. So let's take a look at what's happening. Okay, over here, I signed the contracts on April 20th, again, 420. This is not me. So you got to count debit, credit. So over here, you've got cash, and this is going to be 800 times 10 because I sold 10 grills. Okay, so we can just fix this over here. There we go. So I'm receiving $800, right? $8,000. 10 times 800. However, I have not installed the grills yet, and I haven't delivered them yet. So this is going to be unearned revenue, and this will be unearned installation revenue. So we're going to have 6588, and then we'll have 1411. And then at the same time, I have to show that inventory. Actually, that's a great one. Do I actually? Yeah, no, I need to take the cost of goods sold. Yep, go ahead and debit cost of goods sold, credit inventory. Okay. Actually, this is a really interesting question because okay, actually, no, you don't. Okay, so this is so let's go back to this. So on April 20th, I've accepted money, but I have not yet delivered anything. I'm not recognizing any revenue to record customer advance payment. Okay, now, when I install it on May 15th, 2020, I'm going to be debiting unearned revenue over here for 6588, crediting revenue, basically sales revenue for 6588. I then am also at this point, because I'm actually delivering this, I'm basically taking the grills off my books. The grills had a cost of $425 each. So this is going to be 425 times 10. I'm crediting inventory for 4250. Then I also have to do the services revenue. So I'll have unearned installation, and then I'll call this installation revenue. over here to go through and to record the sale. Okay. You could combine these two here with the services revenue. There's really going to be no, that's not really going to be a cost of sales, but we would maybe want to, when we're going through and doing our financials, is to come up, if that amount is significant, is to be going through and distinguishing what the costs were for that services revenue. Okay, so that's letter A. Letter B. The state of Kentucky is planning major renovations to its parks during 2020 and enters into a contract with Grill Master to purchase 400 durable, easy maintenance, standard charcoal grills during 2020. The grills are priced at $200 each with a cost of $160 each. Grill Master provides a 6% volume discount of Kentucky purchases at least 300 grills during 2020. On April 17th, Grill Master delivered and received payment for 280 grills. Based on prior experience with the state of Kentucky renovation projects, delivery of this many grills makes it certain that Kentucky will meet the discount threshold. Prepare the journal entries for Grill Master for the grills sold on April 17th. Assume that they record the transaction net. Okay, so what that means is when we're doing this one particular problem, and let me do this here. So what we're going to do for this one is we're going to say, okay, how much are we actually going through and receiving? Well, for part B, grills sold, is going to be 400. They're priced at $200 each for a total of $80,000. Okay. So, however, over here, sorry, let me just go ahead. Okay, so I made this mistake on this one. I did not sell 400. It was a contract. Rather, over here, I actually, let's see, the state of Kentucky is planning major renovations and enters into a contract to purchase 400 durable, easy maintenance grills during 2020. So there's going to be nothing written on that because it's just a contract. The grills are priced at $200 each. They provide a 6% volume discount if they purchase at least 300 grills during 2020. They deliver and receive payment for 280 grills. Okay, so it's actually 280 times 200, which is my cost per grill. Now, when we see this over here in terms of should I be going through and recording this at revenue, should be recording this at 56,000. The problem is that if they are getting this volume discount, then, and if it's certain, then the amount of cash they're more than likely going to be receiving is not going to be 56,000 less the 6% discount, or 56,000 times 6%. So the revenue is going to be 52,640. So that is the amount of revenue that they should be recognizing. Remember, they did not sell 400 as I initially had done. They sold 280. So here, my date over here is going to be 4/17. I'm receiving cash. I'm debiting cash for 52,640, assuming that Kentucky wants to not pay me the full amount. Sales revenue, 52,640. Then I have to show the inventory coming off of my books. This is going to be $160 per grill times 280. Okay. All right. And this is to record sales revenue. Okay. So that's how we would do this one right here. Okay. So now let's go to our next one, which is transaction C. Grill Master sells its specialty combination gas wood-fired grills to local restaurants. Each grill is sold for $1,000 at a cost of $550 with terms of $330 net 90. What does that mean? If I pay within 30 days, I receive a discount of 3%. The full amount is due in 90 days. Prepare the journal entries for the sale of 20 grills on September 1st. And upon payment, assume the customer paid on September 25th and the other is October 15th. Assume the company records sales net. Okay, so over here, my grills sold is going to be 20. My cost based on my sales price per grill is 1,000. So over here, my total revenue is going to be 20,000. Now, if I'm recording sales net, what that means is I'm recording it net of that discount. I'm assuming they're going to be taking the discount. So over here, the discount is going to be at 3%. Where did this 3% come from? It's 330 net 90. And I would refer you back to this, which are my videos from accounting for 1A. Go over here to the inventory purchases and you'll see how that kind of works in terms of what those terms actually mean. Okay, so I've gone through and I have done that part. So the amount of cash, or basically if I'm recording AR net to record, or I should call this not AR net, but revenue net, is going to be right over here at 19,400. So right over here on 9/1/20, I'm debiting accounts receivable at 19,400, crediting sales revenue. Over here, I'm going to be debiting cost of goods sold. My cost of goods sold is $550. Okay, and then over here, I have inventory for 11,000. So over here, record sales transaction. Okay. Now, there's two scenarios here. So this is going to be the same for both of these scenarios. So scenario one is that the customer paid on September 25th or they paid on October 15th. Okay, so if they paid on 9/25, right, they're paying within 30 days of this date. So they have the right to take the discount. So here, debiting cash for 19,400, credit accounts receivable for 19,400. Okay, so this is to record cash receipt. So this here is going to be, that's it. Okay. Now, this is where it gets a little bit more funky. If we're over here on 10, basically over here on October 15th, this is 45 days from September 1st. So when it comes to 10/15, right, I'm no longer going to be receiving this 19,400 cash. Rather, what I'm going to be receiving is going to be $20,000. Why is it 20,000? Because they weren't eligible for the discount. However, I did go through and record it like this, so let's see what we need to do next. So I'm receiving 20,000 because they're not eligible for the discount. I'm going to credit AR because I need to take this off of my books. Now, what about this $600? So as I look at the $600 right over here, the way we could do this is they're calling it sales discounts forfeited. I would just call this revenue because that's really what it is. So this would be over here at 600. So that is part C. Now we're going to get to the fun one, which is going to be part D. So let's go ahead and hide these up. We'll do another break right here. So let's go ahead and do part D. Okay, so for part D, on October 1st, 2020, we sold one of its charcoal grills to a local builder. The builder plans to install it in one of its parade of homes houses. Grillmaster accepted a 3-year, 0 interest bearing note with a face amount of $5,324. The grill has a cost of $2,700 and interest rate of 10% is an appropriate market rate of interest for this customer. Okay, so what exactly is this? Okay, this is called $1 today is not the same as $1 tomorrow. I'm not going to be paid for 3 years. So 3 years from now, the customer is going to be paying me $5,324. So paid 3 years from now, $5,324. Okay, so we're going to get into some little present value. So if I'm not going to be paid until 3 years, or 21, 22, 23, this will be 9, 15, this will be 9/30, 23. I can't record. So what I'm trying to do is I'm back here on 10/1/20, right? So I know I'm making a sale right now. Okay, so if I'm making a sale, I need to debit. In this case, I know I need to credit some sort of sales revenue. I need to record either an account receivable or it might be a note receivable. And I also need to take this off of my books. So I need to debit cost of goods sold and I need to credit inventory. Okay. So my cost of goods sold here is 2,700, inventory 2,700. That's the easy part. But what I need to figure out though is sales revenue. Now my problem with recording this full 5,324 is that this is not an amount I'm going to be receiving until 3 years from now. So the question becomes is what is this 5,324 worth today? So when we go and look at present value, and I'm going to take you now to a different set of videos. The ones that are going to be applicable here are going to be, if I go over here to my modules and go to my general information, videos from Accounting 1A, and this is this over here. So this is all about bonds. And the reason why this actually becomes important is because that when you have a bond, there is a initial, it's basically a bond is like an interest-free loan. And so there's the principal amount that you pay at the end of it, and then there's the interest amounts that you're paying throughout the life of the bond. So when we're valuing the bond, okay, there's two different parts. There's a new annuity and there's a lump sum. To value the lump sum, what I need to do is that this is being paid out 3 years from now. I'm trying to figure this is yo or year 0, year 1, year 2, and then year 3. So this is not the same as today because if I'm investing this at a rate of 10%, this 5324 is not worth 5324 today, because assuming if I took 5324 and if I'm earning 10%, it's worth a lot more. So what I need to do is I need to discount this back. The way I'm going to do it is I'm going to go to the present value of $1 table, which is for lump sums. And what I'm going to do is I'm going to say, okay, how many periods away is this being paid? It's a 3-year note. So I'm going to go to 3 periods at 10%. So if I come over here and I look at this particular table, the present value of $1, 3 periods at 10%, I get 0.75131. So my amount here is 5324. If I multiply this by 0.75131, I'm going to get about $4,000. Okay, so present value today. So my present value is 4,000. Now, from a practical standpoint, how do I know that this is right? And so this is what I'm going to share with you. So the way this works with present value, so with my principal amount that I'm investing, basically year 0 is 4,000. We'll just use this amount here. My interest rate is 10%. My interest that I'm earning on this is $399. So at the end of the year, my principal plus interest is going to be the sum of those two values. This ending value then becomes the beginning value for, I should call this year 1, year 2, year 3. So my ending value for year 1 becomes the beginning for year 2. My interest rate is still at 10%. So my interest here for the second year is $439. If I'm earning interest on interest, I get that there. Then I bring this over here. Interest rate is still at 10%. Multiply this through. I have 483. My principal plus interest is, oh, look at that right there. 5324. Ah, that's what that means. So this is what we're doing in present valuing. We're going through and we are reinvesting those funds, and that's how we're getting to that value. Okay. So when I record sales revenue, what I'm going to do is I'm going to record this and we'll just use $4,000. Okay. But I'm going to be debiting a note receivable. My note receivable will be for the 5324, and I need the balance. So my balance here is going to be a discount on notes receivable. Now, what this really represents and what's going to happen here is that over the next periods of time, I'm going to be going through and taking this to interest revenue, because that's really what it is. So they're going to be paying me $53.24 ultimately, but of that $53.24, really $4,000 is really from that grill. The rest of it represents interest payments. So right over here, I record this initially on October 1st like this, then on December 31st. This is why I love this book. Okay, so on December 31st, 2020, 3 months have elapsed. So I need to figure out how much interest do I have. To figure out the amount of interest that I'm going to be doing is I'm going to take the note receivable, which is going to be $53.24 less the discount, or $1,324. It gives me notes receivable net, or $4,000. My interest rate annually is 10%. So my interest is going to be 4,000 times 10%, or 400. What I then do is I say, okay, how many months did I have it for? Well, it was basically from 10/1, 12/31, or 3 months. And this is going to be times 3/12, or $100. So I'm going to debit discount on notes receivable, and I'm going to be crediting interest revenue for 100 on each of these. Okay. Of grill to record interest revenue. Okay, that's exciting. Wow. All right. So just so you can kind of see how this is going to play out over time, and what happens with this note receivable. So year 1, year 2, year 3, it's a 3-year note. I'm going to do it like this, and it's for a reason. So my note receivable on year one was basically notes receivable net is 4,000. My interest rate is 10%. So my interest is going to be 400. Okay. What ends up happening with this interest is it gets amortized against the discount. Okay. So as you see here, discount on notes receivable, this gets amortized to interest revenue over time. So here, I'm going to take for year two, I'm going to take 1,324 minus 400. I get 924. Sounds like a really terrible Porsche. It's now a collector's item. So now I've got my interest rate. I now have my, my notes receivable carrying value is now 4,400. So my interest rate is at 10%. Multiply this through. So the second year I'd be taking 440. In year three, my discount has now been amortized by another 440. So when I multiply this through, so my notes receivable net is now 4,840, and then at 10%, when I multiply this through, I get 484. When this thing gets repaid, this discount has been amortized to zero, and then that's what you would go through and do. So that is, in a nutshell, problem 18-3, and I only have 6 more problems to go. Figure that out. Okay, hopefully you found this helpful, and I look forward to seeing you on the next video, and have a great one.